Okay, welcome to the Swing Trading with Cycles channel. We're going to cover the precious metals today. It is December 5th. It's the first full week of December. We've already had a couple days trading, and we're getting a pretty big pullback in the precious metals today. So let us start with silver. We'll start with the daily chart, and I tweeted about this. Definitely, if you're not following on Twitter, take a look at the link in the description. You definitely want to do that. I provide much more timely updates. So I tweeted about this several hours ago, like in the morning, that we're getting a much needed pullback. Now the details are important. That pullback needs to hold certain levels, and let's talk about those very clearly. So first off, onto the daily chart. We talked about this in our last video that we had this swing low on day 26, and it's like, oh, this is the start of a new cycle. At this point, I don't think that's the case anymore, right? Hindsight is always 2020, right? So this is day 27, 28, 29, 30, 31, 32, 33, 34, 35, 36. I believe that puts us at day 36. And this is in one of my tweets over the weekend as well. So if we call that day 36, we're getting our daily cycle pullback now. Now the good news is that's pretty late in a daily cycle, so maybe that means we don't get a pullback that lasts really, really long. But there are no guarantees there. I mean, this is probably the cycle that we want to avoid. Not saying that this is what we're going to see, but look at this thing. Right, we got this pretty deep pullback, and then we rallied to a day 34 top, right, this whole thing, and then we just gave it all back. We just collapsed. I mean, this is a double bottom, but like, how much fun is that, right? Making all these profits and then just giving it all back. So all that to say, and the important point there is that cycle didn't bottom until day 55, so we still continue to drop for another 22 days. So that is possible, but what you want to orient your eye to is this 10-day moving average. That's this blue line here. Now, there's nothing mystical or about moving averages, but here's the thing: a short-term moving average, by definition, price is going to fall below that short-term moving average at some point, right? That's literally how it works. Why? Because And I noticed I said short-term moving average, not necessarily 10-day, because you could use a 10-day moving average, or you could use an 11-day, or a 9-day, or an 8-day, or a 12-day. It doesn't really matter. Obviously, once you get higher up there, it starts to be less short-term. But the point is, it's not a magic number. It's a concept. When price retraces, at some point, it's going to fall below the average price of the last several days. That's just math, right? And so it's not surprising that every now and then the price is going to fall below the 10-day moving average. Or again, you could replace that with 8, 9, 11, 12, whatever. So we could see it's all the way down here, right? And so we're still quite a bit elevated above the 10-day moving average. And that's almost our saving grace here, in the sense that this sharp pullback would be pretty concerning if we hadn't had this huge run-up, right? Because we've had this huge run-up, this can be acceptable. And that emphasis on the word can. It's going to have to stop at a certain level here, and we'll talk about that. But we expect it to cross below the 10-day moving average, and not to mention that is one of the criteria you have for a daily cycle decline. My point there, though, is cycles aside, the idea that price retraces to that 10-day moving average, it will always happen. That's just a feature of how price works, right? So we have quite a bit of ways to go before we get there, but more importantly, on the weekly level, we really want to hold above last week's low. It's really that simple. In an uptrend, you're making higher highs and higher lows. And so we've clearly just made a lower low on the daily chart. That's bad. But we want to keep that from becoming a low on the weekly chart. And that would be a low below last week's low, which is $20.87 thereabouts. And you can see it's a pretty huge candle. So theoretically, we have a lot of there's a lot of room here, but we're falling really fast. And the other thing I will point out is that this is a bearish outside daily candle, right? Because we made a new high, so new high for day 36, and then we went red and started to fail. Once we started doing that, when I tweeted about this earlier, we had not made a new low yet, but that was already the expectation. That's always the expectation when you make a new high and then you go red. Just as if you make a new low and then go green, you expect that you'll make a new high, right? So this is a bearish outside candle. An outside candle is a candle that makes a new high and a new low. And so because we have a bearish outside candle on the daily, it means we can end up having a bearish outside candle on the weekly. And you can see that with your eyeballs, right? This is a new high for the weekly cycle at week 14, just as today was a new high for the daily cycle on day 36. And so that's ominous because that sets us up for a situation where this could be our daily cycle top. The first signal you'll need is a weekly swing high, which is a move below the previous week's low. And so again, that $20.87 kind of area. We could also see a world where we just kind of consolidate. This thing doesn't go much deeper this week, and then we get the move lower next week that goes below this week's low. Either way, caution flags are warranted. But also keep in mind that, like, you see these candles with the lower wicks. Anytime you see a candle with a lower wick, it means it was a red candle. This is a not good example. It means it was a very deep red candle that recovered all of that. So it's very early. It's only Monday. So a lot can happen, right? The other thing I will call out is the low from last week is just about where the 200-week moving average is. So a lot of confluence. You can see a world where we get all the way back there and then finally retrace. And that's the last thing I'll call out for silver, and then we'll go through gold and GDX. Same sort of set of charts. Look at that monthly chart. I always say it's incredibly important to understand two things, right? What is the current month, red or green? Because that tells you if price is going up or down, right? Very simple. If it's red, it's going down. If it's green, it's going up. And that second question, very important as well. What is the opening price? Knowing what the opening price tells you, knowing what the opening price is, tells you the level price needs to stay above in order for the candle to remain green. Or if you're red, it tells you the price that the level that price needs to achieve to go red, or to go green. All that to say, this month's candle opened at $22.16. And so we are just 2 cents above that right now, threatening to go red. And we also have all this bearish, ugly upper wick. Just kind of thinking about let's say the bearish scenario here is that this could become a monthly swing high, just as this was a monthly swing high. I mean, look at that, right? We came up and then just gave it all back. And then the next month we made a new monthly low, and then we resumed the trend lower. So a lot of caution flags here. But again, it's very early in the week. Just know your levels. No need to get emotional. You just know the levels that we need to hold. For gold, we're seeing a very similar pattern. Bearish outside daily candle. For gold, that's day 19. And for gold, the weekly level that we need to stay above, the low from last week was 1739.70. I tweeted about this. So below 1739, call it. This becomes a swing high, and we're at risk of starting a downtrend on the weekly. But I'll say we would still be above this swing low here, which is that was like a spike lower to 1726. So you still have a chance as long as you're above 1726, even if we do go below 1740. But at the same time, at that point, you're kind of you're really kind of stretching this structure here, right? Which is a bull flag off of this, but you're really starting to kind of stretch it at that point. That's your weekly. And your monthly chart, very big implications here. We're still holding out the idea that this September could have been our 8-year cycle low. For gold, it's the monthly candle has already gone red. We opened at 1767, and we're down here just a couple of dollars, a dollar below, and so we're going red. Will be important for us to try to recapture that 1767 level to keep the green going. You can see we had 7 months in a row that were red, and then we finally got a big, beautiful green month. Would be good to follow that up with another green month, obviously. An absolute worst case scenario would be gold making a bearish outside candle for the month. And that would same thing is in play for silver as well. You have to understand that like action on a lower time frame can cascade higher onto higher time frames. So a bearish outside candle can create a bearish a bearish outside daily candle creates a bearish outside weekly candle, which can create a bearish outside monthly candle. Finally, let's look at GDX. So GDX, same pattern. This is your monthly chart. Made a new high, now going red. Not auspicious. For the weekly, though, for GDX, we did not make a new high, actually. We're just an inside week so far. And that is a high of $30.27 and a low of $27.25. $27.25 is that level that we want to be mindful of. So that's like another $1.50 down. But this is definitely looking healthiest of the three GDX, between gold, silver, and GDX. And you can see, again, same pattern as everyone. We've made a swing high on the daily chart, very clear below here, right? Because this candle marks the high at day 19. And we made a swing high on Friday, but then we recovered, and now we're pulling down again. And you should know the broader market is moving into a daily cycle low, so it makes sense that precious metals as a whole are going to get dragged down, especially something like GDX. And I think so the last thing I'll look at is the gold to silver ratio. And so I tweeted about this, the idea that gold, like, even ratios can have cycles, because cycles are really just price action. And so if we think about the daily cycle, this last daily cycle, little cycle, was 25 days. It was left translated because it only had an 8-day rally. And so this daily cycle has been 7 days. And now we may be getting a daily cycle low here on day 19, which is also about to become a bullish outside daily candle. All that to say, you would expect at least a few more days of gold outperforming silver, which usually means that both are going down, but gold is just going down less. Just important, like, this indicator, like this gold to silver ratio generally moving lower is positive for both gold and silver. When it's moving higher, it means gold is outperforming silver, but it's only because they're both going down and gold is not going down by as much. Generally is what that means. So we'll be continuing to look at this to try to give us kind of additional signal, right? Because we would expect that this little rally would not last more than 7 days, let's say, right? Like this one. This one was 8 days, so it's starting to give you a kind of a sense. Like, you can only muster just a few days of rally. If we see that's not the case, that's going to be a warning sign that we're going to want to pay attention to as well. So we'll leave it at that for our precious metals update here on December 5th.